Hello friends, welcome to learning sessions, and this is the session related to the ABFM class number 13. This is the class number 13 here we are having, and this session is related to the ABFM, and we are covering the module B, right? And we are covering the chapter related to the investment decisions. And this is a part 2 related to the investment decisions. So do confirm the audio video quality at the earliest so that we can proceed. So it is related to the investment decisions. And now we are going to consider a very important part related to the chapter number 9 from the module B. So please do confirm the audio video quality at the earliest so that we can proceed. So audio video quality is all working fine. So let's start the session. So the first thing that we are going to cover today is about the methods of investment appraisal. So the first thing we are going to cover is about the methods of investment. The first one, it's about the payback period method. It's about the payback period method. Payback period means what? That the time which is required to basically recover the initial investment. Let's say you invested the amount of rupees 1 lakh, right? And further you invested in the year 0. Now you got the rupees 25,000 return every year. And by the 4th year, you'll be recovering the complete amount of rupees 1 lakh that you invested previously. Okay, so you invested the amount 4 years back. You got 25,000 in the first year, 25,000 in the second year, then third year, then fourth year. The total amount that you got is rupees 1 lakh. That is basically what 4 years would be. What 4 years would be the payback period. That will be the payback period, right? So the formula is what? It's basically the initial investment. The formula is the amount that is invested initial investment, or divided by the annual cash flow. That is a formula. That is the formula. And it can also be the scenario. It can also be the scenario that the net cash flow every year is not the same. It is not the same. Let's say you got 25,000 in the first year, 37,000 in the second year, then 38,000 in the next year, 39,000 in the other year. So now how you will be calculating the how you will be calculating the payback period? So we are to still to consider it. Then particularly what it will be, like initial investment again divided by the annual cash flow. Like if it is not fixed, like sometimes the case could be like if it is not fixed, then we are to add up the net cash flow from the first year till the total, and further we are to look at what particular point it will be total equal to at what particular point, right? When you are having the unequal cash flows, like I was just explaining to you. Let me just give an example. Let's say you are having the 80,000 in the first year, 60,000 in the second year, 60,000 again in the second year. That's the annual cash flow. 20,000 in the fourth year. And the initial investment, let's assume it was 2 lakh rupees. Initial investment was 2 lakh rupees. Now, what will be the payback period? Any idea related to it? How you are going to calculate the payback period here? So we have to look at the cumulative cash flow. So for the first year, cumulative cash flow is 80,000. The second year, 80,000 plus 60,000. That is 1,40,000. For the third year, 1,40,000 plus 60K. That is 2 lakh rupees. Further, for the fourth year, it is 2 lakh plus 20,000 to 20K. So this is how it will be working. So at the end of the third year, you are able to complete the value. So the payback period would be 3 years. Payback would be 3 years for that case. right? And what if in the same case, we are considering that our annual investment is not, initial investment is not 2 lakh rupees, but if it is 2 lakh and 5,000. Now we are able to recover 2 lakh up to this particular point. In the third year, up to third year, we are able to we are able to basically get back rupees 2 lakh, but 5,000 in the next year. In the next year, the total cash flow is 20,000 rupees in the fourth year. So the fraction of the year would be equal to what? It will be equal to 5,000, the amount that was left, divided by 20,000. That is 0.25. So that will be added back to it. So it is 1, 2, and 3 complete years plus the fraction year for the fourth year. Getting it? So this is how we can be calculating. Now, the point is that we are not considering the time value of money here. We are not considering the time value of money. That's why it's a simple payback period. The limitation is that we are not considering the time value of money. But for the discounted payback period, we do consider the time value of money. For the discounted payback period, we do consider the time value of money. Otherwise, we don't consider the time value of money. So it simply basically identifies the period in which the initial investment basically will be recovered. But what after that? We are not looking at the profits that we will be having after the payback period, or losses may be having after the payback period. So that's the limitation. So the first point is it identifies the period only in which the initial investment is recovered. But as I just told you, it is not looking into the time value of money. That is very much important for us to look into. So if it is discounted payback period method, then it is different. But otherwise, like, it is not sufficient enough. It's a very simple concept. This is suitable for the small businesses, definitely, right? And the shorter the period is, better it is. Like if your payback period is 1 year and the other company is having the payback period of 3 years, what does it mean? It means you are able to recover your initial investments in 1 year, but the other company is able to recover their initial investment in 3 years. So definitely your company is performing better. But the payback period method does ignore the cash flows beyond the payback period. Beyond the payback period, after the payback period, the values are ignored. And this is not scientific. Like, it is focusing just on the recovery, right? The second method, it's about the discounted payback period. The discounted payback period. Here was an example also. We'll be covering that particular part also. Right? Let's have a look at this example first of all. So the question second over here, it says a project cost rupees 20 lakh yields annually a profit of rupees 3 lakh after depreciation. And street line method of depreciation is there, but before tax at 50%. Right? So the project cost is 20 lakh rupees, annual profit of rupees 3 lakh after depreciation. Straight line method is being used, but before the tax at 50%. So the profit before tax is 3 lakh rupees and tax is 50%. So that is to be deducted. So profit after tax would be 1,50,000. But we are to add back rupees 2 lakh. Why 2 lakh is being added up again? Why the depreciation is being added up again? Because depreciation is a non-cash expense. The depreciation is a non-cash expense. That's why we are added it up again. Okay. So it is added up again, and for the total cash flow will now become 1,50,000 plus 2 lakh rupees, that is 3,50,000 rupees. 3,50,000 rupees. Okay. So what will be your payback period? You're getting 3,50,000 rupees per year now. So it is 20 lakh rupees divided by 3,50,000 rupees, that is 5.71 years. Because here the annual amount that you're getting every year is fixed. That's why this formula is being used. That is initial investment and the annual cash flow. net annual cash flow. That was the formula related to it. Okay. Now let's have a look at the another example. So ABC Limited analyzed a project requiring initial investment of 2 lakh rupees and is expected to generate the cash inflows as the follow. The following cash inflows are there: 80,000, 60,000, 60,000, 20,000. Now if we just look at the cumulative, we like we discussed above also, it is 80,000 for the first year, 1 lakh 40,000, 2 lakh rupees. Now here your initial investment is covered, so your payback period is 3 years. Payback period is 3 years. And what if the initial outlay become 2,50,000? Now definitely the part that you're going to recover, like you recovered rupees 2 lakh up to this third year, but the 5,000 left because initial investment we just consider 2 lakh 5,000. So that particular 5,000 will be covered from this 20,000. So the fraction of it is to be considered. So it can be calculated like 5,000 divided by 20,000, right? And that will be 0.25. That will be 0.25. So the payback period would be 3 years plus 0.25. That is 3.25. Now the fourth question, it says rupees 30,000 cash outlay for a project with annual cash inflow of rupees 6,000 would have a payback period of 5 years. Definitely. Like if you're having the cash initial investment of 30,000, right? And for the cash inflow is there for rupees 6,000, then the total amount will be recovered in 5 years. The payback period would have been 5 years. But as I told you that the payback period is basically neglecting what? It is neglecting the time value of money. Time value of money is related to what? That we have to discount the future cash flows. So let's say if I'm having this timeline and here is a negative sign. Why negative sign? Because this is showcasing the initial investment of rupees 30,000. There is no inflow. That's a cash outflow. Is whenever cash outflow is there, we basically put a negative sign, right? So here we are having the cash inflow of rupees 6,000 every year for the next 5 years. For the next 5 years, we are having the cash inflows of 6,000 rupees. Now, if we are to calculate the present value, we have to discount these values. We have to discount the future cash flows. The discounting is to be done, right? That discounting is to be done. And what is the discounting factor formula? The discounting factor formula is cash flow into, like, first of all, discounting factor is 1 divided by 1 plus r raised to power n, where r is a discount rate, and n is a number of year. Like for the first year it will be 1, for the fourth year it will be 4. Okay, so we have to discount it. Now here the PVF is given because that question says that we have to discount the values at 15%. Now 15% discount means we are given the value of r. What is the discounting factor formula? It is 1 divided by 1 plus r raised to power n. So for the first year, if we have to calculate the discounting factor, that will be equal to 1 divided by 1 plus 0.15, because the decimal value is to be taken, right? Raised to power n, first year it will be 1. So it will be 1 divided by 1.15. 1 divided by 1.15. That is coming out to be 0.869. That is 0.87. For the second year, 0.756 and so on for the different years. Getting it? So this is the basically discounting factor value, that how we are getting. And we say to be present value factor, because when we multiply the cash flow with the discounted factor value, then it will become the present value factor. Okay, so here we basically calculated present value factor only, not the present value. So when we are multiplying the cash flow with the, when we are multiplying the cash flow with the discounting factor, it becomes a present value. It becomes a present value. And for the, this thing is also said to be the PVF, present value factor. Okay. So we just calculated the present value factor, that is the discounted factor value here for the first year, second year, and up to 10th year. And then we multiplied the cash flow with the PVF so as to calculate the present value. And here we are having the cumulative value, that for this year plus this one is equal to this plus this one plus this equal to this. Okay, getting this part. So we basically invested rupees 30,000. 30,000. Now up to the 10th year, we are able to cover 30,114 rupees. We are able to cover 30,114 rupees. So, and up to the 9th year, we have covered 28,632. So what is the difference between 30,000 and 20,862 rupees? So it is 30,000 minus 28,632. That is 1368. That is 1368 is the difference. So 1368 will be covering in the next year out of 1482. So for the next year, the fraction will be calculated like 1368 divided by 1482. 1368 divided by 1482, that is 0.92. So the payback period would be 9.92 years. Not simply 10 years even. We can be calculating it in decimals also. So it is 9.92 years. Okay. Here we are considering the time value of money. That is why it is said to be the discounted payback period method. Discounted payback period method, not the simple payback period method. So the next one, it's about the accounting rate of return. The next method that we are going to cover, it's about the accounting rate of return. Now, what is ARR? ARR is actually the average annual accounting profit. Average annual accounting profit from the investment. So let's say if you are having the average annual profit of rupees 2 lakh rupees, you're having the average annual profit of rupees 2 lakh and the investment amount was 20 lakh rupees. What will be your ARR? That will be 2 lakh divided by 20 lakh multiplied by 100, that is equal to 10%. There are multiple formulas for calculating the ARR. Right? So it is better than over the different methods. See, in case of the DCF, that is a discounted cash flow method. In the case of the DCF, like we do estimate the current value of the investment. We do estimate the current value of the investment. Like we do take into account the future inflows. Now, future inflows you might be knowing sometimes, and you make assumptions of so many assumptions about it that these things will be there. Then we will be having this much future inflow, right? So that's basically assumptive. That is kind of assumptive. But in case of the ARR, like it uses a accounting profit. It uses what? It is uses a accounting profit. You look at the accounting profit only. You're not looking into the cash flows. So it is based on average earnings. It is based on the profitability approach. And it is quite easy to understand, right? Because when you are estimating the cash flows, those cannot be that much real. Those may turn out to be unreal in the future. Those may turn out to be unreal in the future. So the formula is what? The formula is quite simple. It's average annual profit or average net income divided by the initial investment. That's it. That's the formula about it. So let's have a look at this particular question. So ABC Limited is going to invest in a project, the sum of rupees 3 lakh, having a lifespan of 3 years. So you are investing rupees 3 lakh for 3 years. Salvage value is given to be 90,000 rupees. The profit before depreciation for each year is 1,50,000. So the profit after tax and the value of investment in the beginning, and further that will be like profit before depreciation is what? It is 1,50,000. And we are assuming that the depreciation is basically, we are assuming to be the straight line method of depreciation. And further in that scenario, it will be like 3 lakh value will be consumed, right? 3 lakh value is basically consumed. But we are assuming the depreciation over here. We are just assuming the depreciation. or we are having the depreciation? Say, it's already given in the question. It's already given in the question. Like you are given with the salvage value. Value is basically the residual value. Okay. So you are having the asset value of rupees 3 lakh minus the salvage value, that is 90,000, because you can be selling it after the usage even for 90,000 rupees. So it is upon 2 lakh 10,000, the depreciation is to be calculated for 3 years. So for each year, the depreciation would be equal to 70,000. Now getting from where the value came, we're not assuming it as such. From here, we got the depreciation value. From here, we are getting the depreciation value. Okay. So now you're having the depreciation value of rupees 70,000, and profit before depreciation was there, and profit after depreciation would be what? It will be 80,000 rupees. It will be 80,000 rupees. Now we are looking at the value of investment, like in the beginning and in the end. In the beginning and in the end, we are looking at the benefit. So if we are looking at the value of investment, 3 lakh rupees was invested, and at the first year end, it remained to be 2 lakh 30,000 minus the depreciation only. Second year, it began with 2 lakh 30,000 and it left only 1 lakh 60,000. Then the depreciation also charged for the third year, and it is 90,000 here. Getting it? Now we are having the formulas over here. Like I just told you that we are having the multiple formulas for it. I just told you that we are having the multiple formulas for it. Let's have a look at it. So the version number 1 says if we are calculating on annual basis, we have to calculate the ARR. If we have to calculate the ARR on the annual basis, it will be equal to what? It will be equal to profit after depreciation divided by the investment at the beginning of the year. Then it will be in such scenario like profit after depreciation, like annual basis ARR. You're having the multiple formulas. So the first one, it's about the annual basis ARR if you have to calculate. Right? For the year one, it will be, you are having the profit of 80,000. So it will be 80,000, and investment in the beginning, it is 3 lakh rupees. For the second year, it will be equal to what? It will be equal to 80,000, and further divided by 2 lakh 30,000. If on year basis, I'm to calculate the ARR, then this formula will be used. Getting it? For the year one, it will be, if I'm calculating the percentage, it is 80,000 divided by 3 lakh, percentage, that is 26.67%. For the second year, it will be 80,000 divided by 2 lakh 30,000, percentage, that is 34.78%, and so on. Then it will be year on year basis. The first part is when we are calculating on year on year basis, annual basis ARR. The second version, it is related to what? The second one, the total investment basis, the total investment that we have made. So for that particular case, the formula is average annual profit divided by the initial investment. Now, what is average annual profit? Average is like that profit for the first year, for the second year, for the third year divided by 3. So it is 80,000 rupees. Average annual profit is 80,000 rupees divided by investment in beginning. Investment in beginning is 3 lakh rupees. What is the investment in beginning? It is 3 lakh rupees. So we can easily be calculating the percentage like 80,000 rupees, and further divided by 3 lakh rupees multiplied by 100. So that will be what? That will be 26.67. That's a second when we are to calculate the on total investment basis. First one, when we have to calculate on year basis, ARR. Second one, it's related to when we are to calculate based upon the total investment basis, right? So that's basically the total investment. And here it will be like 80,000 divided by 3 lakh rupees multiplied by 100. And the third one, it's related to the average investment basis. Here we have to calculate the average investment. Now, what will be the average investment? Like you are having the initial investment of rupees 3 lakh. we are having the initial investment of rupees 3 lakh and the end investment is rupees 90,000. So average would be 3 lakh plus 90,000 divided by 2. That is 1,95,000. Average investment is 1,95,000 and average annual profit would be what? It is 80,000 plus 80,000 plus 80,000 divided by 3. So it is 80,000 for the profit and for the 1,95,000 for the average investment. And here we can be calculating the ARR. So there are three different bases related to it. One, we are calculating the ARR on annual basis. Second, annual, basically we are to calculate the ARR on the total investment basis. And third, for the investment basis. Getting it? Getting the idea? Okay, so that's about the ARR. That's about the ARR. Then the next point, it's related to the NPV. It's about the NPV. Now, what is NPV? It is net present value. It is the net present value. And how one can be calculating the net present value? Very much easy to calculate. So NP is nothing but it's a algebraic sum of the present value of the cash flows. That's it. Now you'll be saying how come it is that much easier? First of all, in case of the net present value, as the name suggests, we are calculating, we are looking at the present value of the cash flows. Let's say the initial investment of rupees 10,000 was made, and then after that we are getting the gain of 5,000 in the second year, 7,000 in the third year, and 2,000 in the third year, right? So this is 0, this is 1, this is 2, this is 3. So I told you that what is the present value factor? That is a discounting factor. So what will be the present value? That will be the cash flow divided by the 1 plus r raised to power n. This is a complete, this is basically the present value. This is the present value of the cash flow. Okay. So I'm to calculate it for the first year. For the first year, it will be equal to what? Let's say if I'm assuming the discounting rate to be 10%, I'm considering it to be 10%. And if I'm to calculate the present value of this timeline, it will be equal to what? The net present value would be equal to minus 10. Why minus 10? Because it was a cash outflow. For cash outflows, it is minus sign. That's why I said that it is an algebraic sum of the present value, okay, of the cash flows. So it is minus 10 divided by the 1 plus r. Now r is 10%. So it is 1 plus 0.10. That is 1.10. And this is for the year 0, right? So it will be raised to over 0. And plus the cash flows now. 5,000 divided by for the first year. So 1.1 raised to power 1. Plus for the second one, it is 7 divided by 1.1 raised to power 2. And for the third one, it will be 2 divided by 1.1 divided by raised to power 3. So if we just do calculate it, we will be getting the present value, that we will be getting the net present value. We will be getting the net present value. So for the first term, it is 10,000 itself. So it is 10,000 itself because it was thousands. For the second one, it will be 5 divided by 1.1. That is 45. That is the value. For the for the third one, it is 7,000 divided by 1.1 divided by 1.1 again. That is 5785. 57. I'm not considering the decimal values for now, just for making the calculation easier. It is 1502. 1502. No, it is minus sign here. So if we just do get the sum of this, like 4545 plus 5785 plus 1502 minus 10,000, it's 1832 positive. So it is positive 1832. Getting it? This is the value I'm getting. This is the value that I'm getting over here. So point is, if your NPV is positive, like the way same method that how we calculate it, and if your NPV here, the value that we got at the end, it is what? It is the NPV. It is a net present value. If your NPV is positive, we say do go for the project. You're making money out of it, right? And if NPV is negative, do not go for the project because Ultimately, we are to use these methods not for the calculation. We are to use this method for the capital decisioning purposes. We have to take the capital decisions. Capital investment decisions are to be taken, right? So we will be using NPV. Like if NPV is positive, do undertake the project. If it is negative, do not undertake the project. If it is zero, then no profit, no loss scenario it is. Getting it? So this is what is told over here. Positive NPV means project can be going, you can go ahead with the project. If it is negative, it's a right signal. Don't go for it. And if it is zero, then it's like not going to add any value to you. You're not going to lose anything. Okay. So this is how we can be calculating using the NPV. So what is the main strength of the NPV? What is the main fundamentality to NPV? First of all, it considers the time value of money. Main strengths. It basically considers the time value of money. That you do consider the time element. Very important advantage. And it is scientifically reliable. It is a realistic approach. And it measures the actual value addition. It's going to measure the actual value addition toward it. It considers the entire life of the project. Entire life of the project is being considered. Okay. And what are the limitation? First of all, you basically do apply the discounting factor. Now we consider the discounting rate to be 10%. We are finding it like positive. Let's say we consider the discounting rate to be 11%, to be 15%. We consider the discounting rate to be 15%. Now, if it is discounting rate of 15%, it will be red. It will be negative. NPV will be coming out to be negative. So it all depends upon the assumptions. Now, you basically take so many assumptions about the cash flows, about the discounting rate, everything. So it's like estimating the future. It may be inaccurate. Okay. And the complex calculations are definitely there. You look at the calculations, no, that was basically just for 4 entries. What if it was like for 100 entries or 1000 entries? Then it is much more complex, much technical, and it does not directly show the percentage return. It just shows the absolute value. We are just getting the absolute value here. 1832, like you are getting, it's an absolute value here. That's the point related to it. Then after that, it's about the working capital adjustment in NPV. It's about the working capital adjustment. It's about the working capital adjustment in NP. So working capital is equal to what? It is current assets minus the meaning of working capital means current assets minus the current liabilities. Okay. So if you are having the increase in the working capital, if the working capital is increased, the cash outflows will basically, there will be impact on cash outflows. If the working capital is increased, there is impact on the cash outflows. And if the working capital is decreased, there will be impact on the cash inflows. Right? Reason is what? That more money will be getting blocked into the current assets. If your working capital is increased, like if you're having more current assets, then only the working capital will increase. Then definitely it will be impacting your cash outflows. And further, if working capital is decreased, your cash inflows will decrease. There will be impact on the cash inflows. Right? So therefore, like if the money is getting blocked in the current assets, the working capital changes must be included in the NPV analysis. That must be included. So that you can be having a correct picture of the cash flows, working capital adjustment whenever necessary. There it is. Right? The next point, it's related to the capital rationing. Capital rationing means we are to limit the investment due to shortage of funds. It means we are to limit the investment because there is shortage of funds, because resources are limited. So the company cannot be accepting all the projects. It's not possible that we are going to accept all the projects at all. Right? So let's say no fresh investment during the year, no borrowing for the project, or restricted use of the retained earnings. These are the examples of it. These are the example of it. Like these are the examples of it, right? And basically the factors basically which are used in capital rationing, like you are accepting only the highly profitable projects, you are looking for higher IRR, you're just based on the profitability factors basically which are used in capital rationing. Why? Like if I'm having the 10 projects opportunities, I'm having 10 opportunities. Now I'm having the limited resources, I cannot be taking all. So I'll be taking the most profitable one. Let's say number third is the most profitable one. I'll be taking that particular project, which is the most profitable, right? And further, let's say I'll be looking for the better return per rupee. That's a profitability index I'll be looking into, better return per rupee. Or I will be looking for that particular project which is basically inflation linked or risk free interest rate is there, right? So those are the factors which are to be included in the capital rationing, right? So now let's have a look at this particular question. So we have to calculate the NPV of a project with initial investment of rupees 1 lakh. The net cash flow for the year one is 55,000. For second year, 80,000. For the year third, 15,000. And the cost of capital that we are considering to be the discount rate. It is considered to be 10%. So what will be the, how will be solving it? So first of all, it is a number for the cash flows for the year zero. There is investment. We are considering the present one. There is investment, right? And the investment is of 1 lakh rupees. So it is cash outflow. So negative sign for it, right? For the year one, there is cash inflow 55,000 rupees you're getting. For the year two, you're getting 80,000 rupees. And for the year three, we are getting 15,000 rupees, right? Getting it? No, the next step would be related to what? If you understand the points, if you understood the point, what will be the next step related to it? It will be like that we are to calculate the discounting factor, or we say to be present value factor. So it will be 1 divided by 1.1 raised to power 0 for the first. So it will be 1 here. And for the first year, it will be 1 divided by, so for the zeroth year, it will be 1.1 divided by 0. And for the second first year, it will be 1.1 divided by 1. And further for the second year, it will be 1.1 divided by 2. So 1 divided by 1.1. 1 divided by 1.1. So for the first year, it is 0.909. Second year, it is 0.826. For the third year, it is 0.751. Now, if we'll be multiplying these two, like this one into this equal to this, so we'll be getting the present value. So 10,000 into 1, present value of 10,000. And for the 0.909 into 55,000, that is 4,995. For 80,000 into 0.826, it is 66,080. Third one, 15,000 into 0.751, that is 11,265. So if we get the sum total of the same, so it is 40, it is not 1 lakh rupees here, not 10,000. So 4,995 plus 66,080 plus 11,265 minus 1 lakh. It is 27,340. So what should be your decision? What should be the decision? Definitely NPV is greater than 0. We should be accepting the project. We are to accept the project, right? Clear so far? The next approach is also very much important. It's about the internal rate of return. It is about the internal rate of return. So internal rate of return is basically the discounting rate. It is basically the discounting rate at which the NPV is equal to 0, or NPV turns out to be 0. So IRR is basically the expected annual rate which is generated by a project. Expected annual rate which is generated by the project. So if your return is greater than IRR, so higher is the IRR, so you'll be taking up the project. So lower the IRR, you're not going to take the project. So if you have to basically like consider the multiple projects, P1, P2, P3, multiple projects are there with you. And IRR is basically the internal rate of return. That is what is the return that you're getting. So you just be considering the IRR. Like if the internal rate of return is greater than the cost of capital, then you'll be going for the particular project. Otherwise not, right? And if you're having the multiple projects, about the single project, if it is greater than the cost of capital, just undertake the project. But if we are talking about the multiple projects, then we have to select the IRR which is highest. Getting it? So NPV formula we just know. NPV is equal to cash inflow, that is the initial investment, minus the summation of cash inflows, that CT divided by 1 plus R raised to power T, right? That was actually related to it. Now for R, we are replacing the R discounting rate with the IRR, because we are considering IRR to be the rate at which the NPV will become 0, at which the NPV is equal to 0. Okay. So this is IRR, internal rate of return. And present value factor formula I have already told you. Okay. So if the same cost apply for the different projects, then the projects with the highest IRR, as I just told you, project with the highest IRR is to be selected. And for an independent project, we have to check if IRR is greater than the cost of capital, then accept the project. Otherwise not. So if those are mutually exclusive and the cost of capital is same basically, right? Then probably the project with the highest IRR is to be selected. But if it is an independent project, then you should be looking at the IRR with the cost of capital, because if IRR is higher than the cost of capital, then undertake the project, otherwise not. And what are the limitations? The IRR ignores the project duration. It just looks into the point. Like if we are having the project A and the project B, project A and project B, IRR for the project A is 15%, for project B it is 20%. And the duration for the first project is 1 year, and for the second project it is, let's say, 3 years, right? And let's say cost of capital is same in both of the projects. Which project you will be undertaking? As per the decision making, we will be going for the second project. But that's not the case now. You should also be looking into the number of years it is taking to implement. So it is not looking at the fact that the duration is much longer, right? So the first limitation related to it. Second thing, it's related to, like, there is a assumption in case of the IRR, and that is very unrealistic. So IRR assumes that whatsoever the intermediate cash inflows are there, those are reinvested at the same IRR. So whatsoever the cash inflow you're getting, whatsoever the IRR, let's say it was 15%. So we are able to reinvest these inflows at same IRR of 15%, which may not be practically possible. Right? And further, if a project is having the alternating like positive and negative cash flows, if you are having the alternative cash inflows and outflows, then you can be having more than one IRR. That we say to be multiple IRRs could be there. And that basically is going to create a difficulty for the decision making purposes. That can be creating a difficulty for the decision making purposes. Then it is related to the MIRR, that is a modified internal rate of return. It's about the MIRR. So MIRR is basically the improved version of the IRR because it's going to assume the intermediate cash inflows are reinvested at the cost of capital. So that was a limitation, that whatsoever the intermediate during the intermediate years, whatsoever the cash inflows will be there, those are invested at IRR only. But in case of MIRR, we do consider those are invested at cost of capital. Like that's quite possible. That's practical enough, right? So it's giving a realistic approach toward it. So why the particular MIRR is better than the IRR? First one, reinvestment assumption. Like we do assume that the in case of MIRR, the we are going to reinvest at the cost of capital. First thing, and multiple rate problem is not possible in case of the MIRR, and it is more realistic, right? So that's why it is said to be better. Now, what is the process to be followed? Like first of all, we have to calculate the present value of the costs, PVC. We have to calculate the present value of the cost. And for that, the formula is what? PVC is equal to C0 divided by 1 plus R raised to power T. So PVC is basically the present value of cost. And R is what? R is the cost of capital. R is the cost of capital here, right? So present value of cost is calculated. And then we have to calculate the terminal value of the capital inflows. We'll be calculating the terminal value of the capital inflows. Like, and here the R is considered to be the reinvestment rate or the cost of capital again. We are considering it to be cost of capital and the terminal value is calculated. Okay. And after that, we have to calculate the MIRR. And for that particular purpose, we have to solve the equation. That is TV for MIRR. The equation is terminal value divided by the PVC and for the raised to power 1 by n. This is the value, not this one. So the MIRR is equal to this TV divided by PVC raised to power 1 by n minus 1. Okay. So what are the strengths? Improved over the IRR because here it is realistic, undisputed rate of return. We are considering that those are invested at cost of capital, right? And for the both IRR and MIRR not valid for ranking the projects of different sizes. Both are not applicable for the same. Now let's have a look at the question here. So let us say a company is having an option to replace its machinery and option to invest the money. Is having the option to replace its machinery and option to invest the money. The cost and return are following. Initial investment 5 lakh, incremental increase per year 2 lakh, salvage value 45,270, life of asset this, and cost of capital is given to be 10%. Right? So the particular pattern, if we just look at what will the pattern, like initial investment is 5 lakh. So 5 lakh would be the cash outflow. 5 lakh would be the cash outflow, zeroth year. And for the next 3 years, you're getting the benefit. You're getting the benefit. Benefit of what? You're getting the incremental increase per year. 2 lakh rupees are being increasing every year. 2 lakh rupees are being increasing every year, right? So 2 lakh we will be adding up again and again every year, right? So for the first year, the 2 lakh will be there. For the second year, 2 lakh will be there. And for the third year also, the 2 lakh will be there. But also we are provided with the salvage value. Now salvage value is what? Salvage value is the residual value. Salvage value is the residual value, and that is given to be 45,270. So if we consider the fact that you're getting 2 lakh rupees for the first year, again 2 lakh rupees for the second year, for the third year also you'll be getting 2 lakh rupees, but also you'll be getting the salvage value of 45,270. You're getting the salvage value of 45,270 here. So this is the cash inflows and outflows here. And what if we are to calculate the IRR? What if we are to calculate the IRR? Because IRR is a discount rate at which the NPV will become zero. So what is the NPV formula? So what is the NPV formula? NPV is calculated like minus 5 lakh, that is for the first year. For the second year, 2 lakh divided by the particular uh, percentage. But here we are not given with the percentage. So we are writing it as 1 plus R raised to power 1 plus 2 lakh 1 plus R raised to power 2 plus 2,45,270 divided by 1 plus R raised to power 3. And NPV is becoming 0 at IRR. And R is basically replaced by IRR. So I'm replacing it by IRR. So this is how we are to calculate the IRR. Now IRR as such cannot be calculated directly. So we'll be using the hit and error method. Hit and error method. Like we will be doing what? We'll be considering the two percentages. Let's say 10% and 13%. And thereafter we'll be calculating the different one so as to calculate the IRR. Right? Now there are 2 points. Like here we have already calculated. Just have a look at this particular point. Like I just told you that we'll be considering two discount rates. So here we considered one to be 10% and the other one to be 12%. So the for one case we calculating at 10%. For the other case we are calculating at 12%. Right? And these are the discounting factor points. And further here we calculated the present value. Here we calculated the present value. Okay. So for the first case, when we basically took the discounting factor as 10%, it came out to be 31,321. For the second case, when we took the discounting rate as 12%, it came out to be 12,507. And then we basically used this particular formula, lower discount rate, difference between the discount rates, NPV at basically the lower discount rate, and absolute difference between the NPV at the two DRs. And we just calculated the particular IRR to be 13.32%. This is the IRR that we calculated using the hit and error method. And here the IRR is greater than the cost of capital. Cost of capital in the question is given to be 10%. If you memorize, this is the cost of capital is given to be. And for the independent project, if the IRR is greater than the cost of capital, one should be undertaking the project. One should definitely be undertaking the project, right? So as we can see, like we are having the IRR to be 13%, that's greater than the cost of capital. Since IRR is higher than the cost of capital, definitely the project must be selected, right? And let's say if the company is having another opportunity to invest the money into project that gives 12% of the return, the company will still be going for the machinery replacement because that is going to give you the higher IRR. That is giving you higher IRR, right? So this is to be taken care of. After that, it's about the profitability index. The next topic that we are going to cover, it's about the profitability index. Now, what is profitability index? Any idea? I just gave you the idea in between also. So profitability index is like, it will be going to show you a relationship between the benefits and the cost of a project. A relationship between the benefits and the cost of the project. So it's going to measure the present value of the future cash inflows. And further, it is going to compare it with the initial investment. So we are going to calculate the present value, and whatsoever the initial investment is there, we are going to compare these two things. And this is also said to be the value investment ratio. We also say it to be the value investment ratio, or we also say it to be the desirability factor. We also say it to be the desirability factor, the profit investment ratio. So if you look at the formula, what is the formula? Like the present value of the future cash inflows, the inflows only, divided by the initial investment. That is your PI. And if PI is greater than 1, if PI is greater than 1, we do accept the project. And if PI is lesser than 1, that scenario, reject the project. If PI is equal to 0, then, sorry, equal to 1, then whether you undertake the project or not, it is not going to make any difference. Right? So if greater than 1 means project is profitable. If it is less than 1, not profitable. And if it is equal to 1, no gain, no loss. Now here we are having the 3 projects. And here the discounted cash outflow, it is 5,50,000 in one, 75,000 in second one, and 1 crore and 20,000 in the third one. Okay. And suppose that further sum of discounted cash inflows are 6,50,000 in the first case, 95,000 in the second one, and 1 crore and 30,000 in the third one. So the first one we will to calculate the profitability ratio. So that will be 6,50,000 because it's about the cash inflows on the in the numerator. 6,50,000 divided by 5,50,000, that will be PI1. That is PI1, right? And PI2 would be equal to what? It will be equal to 95,000 divided by 75,000. And PI3 would be calculated same way. So let's calculate it for the first case. It's 6,50,000 divided by 5,50,000, and that is equal to 1.18, right? And for the second one, it is 95,000 divided by 75,000, that is 1.26. And for the third one, if we calculate, it is 1 crore 30,000 divided by 1 crore 20,000. That is one only. For the PI3, I'm writing it directly. It is 1. So which one is better? We have to rank the projects, na? So the project 2 will be ranked first. It will be ranked second, and it will be ranked third. Right? Getting it? So PI basically helps us so as to compare the project efficiency. After that, it's about the social cost benefit analysis, SCBA. SCBA. Social cost benefit analysis. So SCBA is basically used in the government projects, infrastructure projects, public welfare projects like airports, roads, bridges, etc. So we have to look for the social cost and further the relationship with the social benefit. Okay. So social benefit is like if it is giving a positive impact to the society, then it is a social benefit. Like it is creating employment or economic growth, or let's say travel time is reduced, then it is social benefit. And social cost is related to what? Like pollution or let's say deforestation. These are the negative values. So if net social benefit is greater than the net social cost, then we are to accept the project. And if net social benefit is less than the net social cost, we are to reject the project. As simple as that. So even if the financial profitability is not there, but the social benefits are very much high, we should be undertaking that particular project. Get it? So this is repeated one, so we are not going to cover it again. Then after that, it's a comparison between the NPV and IRR. So NPV is basically the present value surplus. Simple, present value surplus, NPV. And IRR is basically the discount rate at which the NPV will become 0. And it is expressed, NPV is expressed in absolute terms and IRR is in percentage. It basically represents the value addition. And the IRR is representing the no profit, no loss, that is break-even point analysis. And the reinvestment assumption, that's very important assumption. Like in case of NPV, we assume that the reinvestment is being done at the cost of capital, whereas in case of the IR, it is basically assumed that the reinvestment at the internal rate of the return only. Decision criteria: if NPV is positive, do undertake the project, otherwise not. And the decision criteria for IRR, like if IRR is greater than for, like if it's for independent project, if IRR is greater than the cost of capital, then do undertake the project. And if we are basically having the different projects, then the highest IRR project will be selected. Okay. So generally NPV is preferred because it maximizes the shareholder wealth. It uses the realistic reinvestment assumptions, and it basically gives the absolute value of the addition. So that will be all related to this particular session. So if you really like this video, do give this video a thumbs up and do rate this video. It really motivate me. If you rate this video, do post it in a comment, and do not forget to like this video and share this video. And the complete CAIIB crash course is available. If you want to get the crash course, simply just do WhatsApp CAIIB crash to the number 83609 44207, and I'll be sharing all the details. So thank you so much and see you again.